Welcome to Finance Tidbits, where today we'll be discussing the yield curve. What is a yield curve? At a high level, the yield curve describes the cost of money for a particular borrower across different durations. That is, the yield curve is a graphic that shows the yields or interest rates across different debt contracts, for example, bonds of different lengths or time to maturity or term. It represents the relationship between current short-term rates and expected future short-term rates. You normally expect the yield curve to slope upwards to indicate that the cost of lending for longer periods of time is greater than the cost of lending for shorter periods of time. For instance, as you can see above, the U.S. Treasury security yield curve, which is featured, is a common government bond yield curve that allows investors to look at the differences in interest rates paid by the U.S. government for Treasury securities with maturities from 3 months to 30 years. That is, this shows the cost of lending money to the U.S. government. There are generally, broadly speaking, three types of yield curves. There is a normal yield curve where long-term interest rates are higher than short-term rates. This means steady expansion. The reason is that investors expect that short-term interest rates will be higher in the future given that the economy is expanding and there may be greater demand for money, thus driving interest rates up. The second type is an inverted yield curve. This is where long-term rates are lower than short-term rates. This potentially indicates a recession brewing. Finally, there is a steep yield curve. This is where long-term rates are much higher than short-term rates, indicating that investors are expecting continued recovery or expansion. Why are yield curves important? Well, at a macro level, it generally helps investors indicate expectations for economic output and growth. For example, this yield curve above for the Japanese government bonds, and you can tell through the three color-coded yield curves from the current yield curve, 1 month ago and 1 year ago. Generally, the yields have been declining from a year ago. Maybe expectations for investors for output and growth are slightly less than they were a year ago. This makes it very interesting to compare yield curves for various countries' governments. Second, at a micro level, for example, holders of adjusted rate mortgages can use the yield curve to predict if interest rates are expected to increase or decrease, which would affect their mortgage rates. Finally, the Federal Reserve of Cleveland reported that negatively sloped segments of the yield curve predicted all but 4 of the past 17 business cycle downturns since 1920. The general message is a negatively sloped yield curve is a potentially dangerous sign for the economy and the stock market. Finally, here are some other resources to read if of continued interest. Thank you for watching. Bye.